Good evening, everyone. Welcome to our first homebuyer workshop of 2024. My name is Jason Maida. It's great to be with all of you this evening. We have a very large class tonight. So coming out of the holiday break, I know a lot of you decided to sign up for tonight's class. And so we're going to allow all of our guests for tonight's call to be able to get into the Zoom session. While we're waiting for everybody to show up, I just want to kind of, again, welcome everyone to our class. And kind of just give you a little bit about logistics for tonight. So tonight's running time for the class will be at just about an hour. This is a very interactive session. So as we roll through tonight's presentation, we go through our content. We're going to be encouraging our audience to ask questions. We'll be answering those live on air, but we'll also be taking those through the Q&A so we can actually respond individually to you. But for the most part, most of the questions we'll be sharing back with the larger group. Tonight's class is recorded. So, if you missed something in tonight's class, feel free to go check that back out on YouTube. And we'll have all the recorded versions of tonight's class. We encourage you to take great notes, but all the content will be available on our YouTube channel. And we also, those of you that, since you signed up for the class, we have your email address. So we'll send you out a copy of today's presentation. Again, my name is Jason Maida, so I'm with American Pacific Mortgage, and we have a special guest with us tonight for our class for the first one of 2024. Leanne Walker from CalHFA, the California Housing Finance Agency, is going to join us later on tonight to talk specifically about the CalHFA program. So that'll be right around the 3/4 mark of tonight's class. Really excited for Leanne to get a chance to join us. Again, tonight's class is very interactive. So as we roll through tonight's content, feel free to reach out to us with any questions during the class, and we'll be able to kind of answer those on air. So let's go ahead and dive in. And we started our screen share already. So, I won't share with you too much about me because we'll get to all the good stuff. But I do facilitate these classes once a week generally throughout the year. So again, this is our first class of 2024. A lot of really good excitement in the market. I think that's why this class is so well attended. We have over 300 future clients, if you will, signed up for tonight's class. So really a lot of you are curious about what's going on in the housing market and kind of how to prepare for home ownership. We are based out of Sacramento. This is kind of our home office, but we service not just California, but we service across the country in educating first-time home buyers in home ownership. And if you like what you hear this evening, we're teaching 53 more classes this year. So if you have friends, family, maybe some coworkers that want to attend some of our future classes, they can check out our upcoming dates on mortgageeducate.com. And before we get into our agenda for tonight, I would encourage everyone, if you get a chance, put in the chat where you're joining us from. It's really interesting as I teach classes across the country to hear where our guests are joining us from, because you may not all be from California. You might be in Texas or you might be in Illinois. And it's always good to get a chance to know where everybody's joining us from, because certain things in this market might not be applicable to maybe where you plan on purchasing, right? So I'm seeing that everybody's in the chat: Sacramento, Moreno Valley. I saw Lake Isabella, Rockland, Marysville. So a lot of Northern California stuff. Got some Southern Cal, Folsom, LA. Okay, that's awesome. So I'll be taking a look at the chat, as well as my partner Ken will be helping me with Q&A and checking out the chat to see where everybody's at, so we can give you some market data appropriate for your home search. Well, here's our talking points for this evening. So we're going to talk about the housing market in just a bit. We're going to do a buy versus rent analysis. So we want to take a look at, what does it look like if I continue down the path of renting versus what could it look like if I decide to purchase a home? So that's our rent versus buy analysis. We're going to spend some time looking at interest rates in just a little bit. That's one of our hot topics for tonight's call, is really what's going on with interest rates and how is that going to potentially influence this housing market. We're going to look at credit and how to best prepare for home buying, to understand your credit, how to optimize your credit score in preparation to buy. We're going to look at student loans and how could they potentially impact your credit score. We'll talk about loan programs that are available to you, not just as a first-time buyer, but maybe as a second or third-time buyer. We're going to then go look at some of the documentation that we typically need for home buying as we kind of prepare to take on this journey. We will then transition to our CalHFA or assistance portion of tonight's class. That's where Leanne will jump in and kind of share with us about the exciting things going on at CalHFA. And then we'll wrap up tonight's discussion looking at the kind of the workflow or the process of buying. So if I say, hey, you know what, I really love what I heard this evening, and I want to see how I too can get on the path towards homeownership, we're going to walk you through those next steps and kind of share with you what a consultation could look like for home buying. All right. Again, thanks so much for sharing with us where you're joining us from. Now, I can't forget to mention that, part of tonight's class is because of the work of our partnership with Sac State alumni and athletics here in Sacramento. So many of you are joining us because of that. So stingers up for all of our guests joining us from Sac State. Really excited that you get a chance to join us there. That's a partnership that we'd love to be able to support here locally and across the country. And so we get a chance to teach this same class to the Sac State alumni 4 times a year. Okay. All right, well, let's dive in now. Let's talk about, when we think about buying, and it doesn't really even make sense for me to buy. I mean, the cost of housing or renting, however we want to look at, obviously we know it's up there, right? Inflation is concerns for all of us here. But I think ultimately when we make the decision, if we want to pursue homeownership, I think we really got to think about what are some of the really great benefits that come along with ownership, because it's not just what I would say an apples to apples comparison. So if I compare my rent budget versus my housing budget or home ownership budget, it's probably not going to look the same, right? So, when I think about buying a house, I create better affordability, hopefully, because, I'm controlling my payment. I don't have to worry about my rent payment increasing over time. This is an asset that I could maybe pass along to the heirs of my estate. Equity comes with appreciation of my home. So equity is created based upon the mortgage balance that I owe on my mortgage versus what the market value is of my home. So that difference is called equity. And there still is some tax benefits that can come along with home ownership. And you may not know that potentially you can deduct interest in your tax situation. So all those things we really want to factor into the equation of thinking about home buying. And I think when we look at opportunities for first-time homebuyers, the first place we really need to start is looking at our monthly budget. So we're going to now transition into our next segment of tonight's class. It's our rent versus buying. And so I'm going to go ahead and switch screens with you for a second. We're going to hop into the Freddie Mac calculator so we can take a look at really a comparison of continue to go down my path of renting versus what it could look like with ownership. As I mentioned earlier, in case you joined us late, all of our material tonight will be shared with you back over email, including the link to this calculator. We'd encourage you to go through the same calculation yourself when you have some free time. So here's that calculator you can see on screen, rent versus buying calculator through Freddie Mac. When you think about Freddie Mac is for conventional loan products. You're going to hear me mention Freddie Mac as well as Fannie Mae in tonight's session. So let's kind of walk through what this budget exercise will be like. So we're first of all going to put in a monthly rent. In this scenario, we have $2,500 a month in rent. We have our expected renter's insurance that we might be paying. And then we're going to assume that our rent would potentially go up 5% every year that I renew my lease. Okay. And then under the homeowners or home purchase tab, we're going to put a baseline purchase price of $500,000. The minimum down payment to purchase a $500,000 home is 3%. You're going to learn more about that in our loan programs section of tonight's class. And then the property taxes are generally estimated at 1.25% of the sales price. We have estimated homeowners insurance. We have the maintenance costs of our home. So those all get factored into the calculation for the homeownership side. And then we also want to add in our loan information. So we're going to put in a 30-year fixed mortgage. Generally, as a first-time buyer, that's what we're going to be probably looking at. We have our estimated interest rate. Interest rates are kind of bouncing around a little bit right now, but certainly at lower levels. And then we're going to look at the cost of our financing, which is also known as origination charges. And so origination charges will be the cost of like the processing of your loan, the underwriting of your loan. One of the really cool things that we have with our Sac State partnership is we actually discount those services by $750 with our Sac State alumni and athletics partnership. And then discount points are an option that a buyer has where you're paying additional costs to bring down your interest rate. In today's market, not necessarily something I would generally recommend, because with discount points, it usually takes about 2 to 3 years to break even on those investments. And for a lot of our buyers that are looking to purchase right now, they're probably going to not be able to break even quick enough on that calculation. So we can certainly look at options for discount points, but a lot of our clients buying right now may be looking to maybe refinance a year or 2 years down the line. And then we have other settlement services. Those are going to be things like title, escrow charges, transfer taxes, some of the recording charges for the county that you're going to purchase in. All of those things encompass what we call as closing costs. And closing costs are usually the equivalent, and I want to say estimate about 2 to 3% of your purchase price. So that's generally what we want to kind of bookmark as our estimated closing costs. Now, the other assumptions we want to make is the appreciation rate of my home. So that means what percentage is my home going to go up in value over the time of ownership. So we put 4% here. We also have how long will I be in the house? How much is it going to cost me when I eventually sell my house in 7 years? Because what we're going to do is we're going to show an analysis of just basically staying on the path of renting or buying for the next 7 years. Then we have state and federal taxes. We have our savings rate as our last input. So what this calculation says is that if I decide to purchase in today's market versus renting in today's market, I have about a $76,000 opportunity of buying instead of renting over the next 7 years. Now, how did we get to that number? Well, equity appreciation is one of them. The other thing is going to be the tax savings that I have. And then we're going to compare that to my rent payments going up 5% each year for the next 7 years, right? And the payment we have to take into consideration is going to look a little bit different, right? Your estimated payment on your rent is $2,500, whereas the mortgage is closer to $4,100 a month. So that $1,600 difference is significant. But I think as buyers, if we're considering purchasing a home, we want to look at kind of the long-term benefits that come along with ownership. All right, so that's our rent versus buying calculator. We have a few things. I think we had some questions. Okay, it's like we had some in the chat. Looks like some of you might have been stuck on the title slide. Let me screen share our calculator just in case we're having some issues with that. Okay, so this is what I just described to everyone over the phone, or over the video. So in case you didn't see that on screen, I think that should be okay now. Let us know if it's not good in the chat. Okay, we're good now. All right, awesome. Thanks for the feedback there. It's like we didn't screen share on that. So this is kind of what I was describing to you guys. So ultimately, you're going to be able to do this on your own, but I kind of walked you through this exercise. But this is kind of what I was sharing with you. This opportunity over 7 years is about $76,000. Now, if you're renting a room for $500 a month, then the numbers aren't going to look as favorable, right? But certainly in today's market, a $2,500 rent is fairly common in today's market, especially in Northern California. And to purchase a $500,000 house in Northern California is reasonable. Now, if you're saying, hey, I'm purchasing in, Moreno Valley, not Moreno Valley, but let's say LA, right? Or I'm purchasing in Santa Clara. Well, that might be a little bit more of a challenge, but this calculator will at least help give you some direction on when it comes to your budget. And of course, as part of our support for you in home ownership, we'll help walk you through that calculator as well too. All right, so that's our rent versus buying calculator. Now let's pivot a little bit. Let's talk about the housing market. Now we're going to spotlight the Sacramento housing market because I think most of you, from what I gathered from the chat, are joining us from the greater Sacramento area, right? So let's talk about Sacramento in general, but I really do think it doesn't look much different than other markets in California. Now the prices might look different, but the trends in the market don't really look a lot different. I could be teaching the same class to some of our Bay Area partners. It would probably look the same as it would maybe in LA. So let's look at Sacramento. So the median sales price in the Sacramento area, believe it or not, it's $490,000. And this snapshot that we have here looks back at the last 3 years in home ownership and home prices, right? So you can see the median home price just above 400,000. We've seen some peaks, some valleys, but ultimately we've landed at about 490 here. Now, what we're seeing right now is pretty common in the marketplace. Not a lot of inventory, which is kind of seasonal in today's market. And you can see in our median days on market, homes aren't staying for very long, right? So homes that are, sellable or favorable in the market are selling quick. It's a 19 days on market as a median number. So things are moving pretty fast. Now, generally speaking, there's going to be seasonality in the housing market. So we're in our winter months, of course. Usually we don't see things pick up until, generally just after Super Bowl weekend, so to speak. We'll start seeing activities get a little bit stronger in the market. Sellers are thinking about listing, buyers are thinking about getting in the market, gets a little bit warmer, starting getting into the spring. But I will say we're seeing some indicators right now that would lend us to believe that that seasonality is going to shift upwards. The buyer activity level right now is really strong. Just to give you an example, traditionally in the holiday break, which was last week, we would probably meet with, give or take, 8 to 10 clients over the course of the holiday break. We met with at least 3 to 4 times that, doing consultations, preparing clients for homeownership entering the new year. So we're going to talk about rate drops in just a little bit, but I will say what I've seen in the buyer behaviors already in this little kind of snapshot of the last week or 2 weeks, this drop in interest rate is definitely fueling buyer behaviors. And I think that's something we need to be aware of if we're thinking about getting on the path to homeownership in 24, because I do believe it's going to be a very competitive market. And so to that point, I just wanted to kind of highlight this slide here, which is, when is the right time to buy? And some of us might be ready to go right now. We're ready after this class to prepare for homeownership. Some of us, it might be more of a long-term plan, but I think it's important to understand the math of when is the right time to buy. So interest rates are looking to trend downward right now. We're expecting potentially 3 rate cuts from the Federal Reserve this year, which will bring rates down from what we're currently at, right, which is around the 6.3 to 6.5 level. Generally speaking, you're going to see more homes active in the market, like I just mentioned, in the spring and summer months. But what happens is, in today's market, there's only so much inventory. But when interest rates go down, it fuels buyer demand, right? So if we have buyer demand go up, inventory stays the same, naturally what's going to happen is prices will push up. It's our old economics 101, supply and demand, right? So I think we all need to be mindful of that if 2024 is the year that we think of purchasing, because more than likely in most markets, we're probably going to see higher purchase prices because of the buyer demand levels. Here's kind of a slide to illustrate that point. So buying now at, let's say, 500,000, and let's say the rate was 6.25%, we could even argue it's 6.5%, and we have a minimum down payment of 3%. If we decide to push off buying for another year, we're probably going to see about a 5% shift upwards in prices, pushing that to about 5.25. Now, those interest rates might be lower at that time, which we've illustrated here, but our down payment increases. And then if you look at it, our savings is not substantial, right? We're waiting for rates to come down, but it only is going to carve out, about $70 worth of savings for ourselves. So it's almost even playing field. So what my thought process would be in considering homeownership, I'm probably more concerned about how much am I paying for my home versus maybe necessarily what the interest rate is, because ultimately our long-term goal would be to create sustainability in our home through a lower priced home option, but also looking at refinancing hopefully in the future in the next year or two when rates get more down to historical levels. So that's kind of how we're thinking about today's market. It's not something where it should be an urgent move for you, but certainly if you're thinking about buying this year, I would encourage you to maybe look at your options a little bit earlier than you otherwise would in traditional markets. Now, interest rates, as I just mentioned, are playing a huge role in buyer activity levels as of late. So if I was to flash back to October of 23, I can tell you the date is actually October 18th. Interest rates hit 8%. And, we were all quite concerned on where interest rates could go because there was really no path in sight to seeing rates come down. And that's what's reflected in this slide here. But as you can see now, we're on the other side of it. We've seen the 10-year Treasury drop in the 3.7 range. Interest rates now have gone from that 8% level down to an average of about 6.5 to 6.75, and obviously changing affordability for buyers and buyer behavior. So more buyers that were maybe interested in purchasing in the spring of 2023, but maybe rates got too out of control, they're now re-entering the market. So you have that doubled up with now new buyers that want to get into the market. So again, that kind of just illustrates the point of there's going to be a pretty big push in buyer demand for this year of 24, which is exciting because our markets can certainly use that. But I think at the same time, the challenge will remain is kind of where does this home inventory look? And certainly some buyers will choose to look at new homes, which those are always available. But when it comes to the resale market, I think we're still going to have a bit of a sense of urgency when it comes to pursuing resale homes. So that's kind of how the market looks right now. I want to just share with you quickly the characteristics of interest rates, because I think it's really important to understand how interest rates work. because a lot of you may look at an interest rate by Googling it, say, okay, average interest rate is 6.75, but I think it's important to understand what's inside of an interest rate. So credit score will determine your interest rate. How much you decide to borrow will influence interest rate. How much I decide to put down for my purchase. So whether it's 3% or 20%, that could affect my interest rate. We talked about discount points earlier, which I'm basically buying down my interest rate. Usually 1% of your loan amount is the equivalent of 1 point, and that 1 point can bring down the interest rate about 0.25%. And then finally, the term of your loan can help reduce your interest rate. So if I go from a 30-year loan to a 15-year loan, generally speaking, that will bring down my interest rate level. Okay. So that's kind of what goes into interest rates. Now let's talk a little bit about credit. And when I think about home ownership for our first-time buyers, there's usually kind of two challenges, if you will, to home ownership. It could be maybe my savings is just not to where I want it to be, or it's on the credit side because maybe I have student loans that are now in repayment, or I'm a little bit overextended in my credit, or maybe I just have some past challenges in my credit. So in our workshops, we always like to review credit to help provide solutions for our future buyers. And so let's talk about credit. And let's first look at the score calculation. And I know many of you in tonight's class probably have Credit Karma or maybe some of the tools offered through the credit agencies. But I think it's really important to understand how the weighting works for credit scores. So the first kind of weighting or component to the credit score is how long have I had credit? So 15% of the credit score weighting is how long I've had credit. 20% is going to be how much new credit am I trying to access? So am I opening up new accounts, or do I have new inquiries that are appearing on my credit? Now, those new inquiries are going to be hard inquiries. Those can impact your credit score negatively. Now, there is a rule in place that allows you to inquire with as many mortgage lenders or auto lenders as you want in a 30-day window of time, and it's the equivalent of one credit inquiry hit to your score. Now, one of the nice things about our process is we only start with a soft credit check, so you don't have to worry about that hard credit inquiry impact to your score. But certainly the 20% component does drag the credit score down a little bit if you're active with inquiries and opening up new accounts. 30% is going to be credit utilization. So what we're looking at there is our revolving accounts. So personal lines of credit, credit cards, overdraft protection, stuff like that. We're looking at the aggregate credit limits versus balances. So if I have a $10,000 limit, $5,000 in balances, I'm at 50% utilization. Now, we know we just got out of the holiday season. We may have bought a lot of gifts and we've charged up our credit cards. Maybe we're at 80% utilization. That higher utilization is probably going to bring down our credit score. So our first kind of benchmark to getting back on track utilization-wise would try to get below 50% utilization. And then after we've gotten there, we want to get to below 10% utilization. Next section is the payment history, and that's pretty self-explanatory. That's 35%. It's the biggest weighting on the credit score calculation. That's certainly how I've paid my bills, right? So if I've had late payments, especially in the most recent 12 to 24 months, that's going to be the most impactful to my credit score. Now, if I've had some late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90+ delinquency. So the more severe the delinquency, the more impact it is to the credit score. Now, every loan program has a minimum credit score. So as you can see on screen, FHA loans, a minimum credit score is 580. Conventional loans, a 620. For some of the veterans products like VA, 620 credit score. And then CalHFA, which you're going to learn a little bit more about this evening, 640 credit score for FHA, 680 for the conventional product under CalHFA. Now, there's various credit score factors that factor into the score calculation. So if you've had maybe events like a bankruptcy or a short sale or a foreclosure, maybe collections, in the most recent year to 2 years from those events, that's going to be the biggest impact to our credit score. I want to give you a quick tip, if you will, on how to manage credit utilization, especially as we're starting the new year. You got to kind of hit the refresh button a little bit and get a chance to maybe create some new disciplines for you in managing your credit card debt. So what I would share with you is that when you manage credit card debt, there's two kind of dates to look at on your credit card bill. There's your billing cycle date. There's also your due date. Now, many of us may be in the habit of just paying our credit cards on the due date, which is totally fine. However, The billing cycle date is the date at which the credit card issuer sends out your payment information, like your how you paid your bills, the balance, the credit limit. That all goes out to the credit agencies on the billing cycle date. So my tip for you guys is that if you can pay down the balance before the end of the billing cycle date, it's going to bring your balance down to hopefully a more acceptable level so you can lower that utilization, raise your credit score. So you're kind of just shifting a little bit when you actually pay the bill. So you're kind of paying a little bit ahead of time, but it's certainly a practice that can help you bring up your credit score. Now, there are 3 credit scores that we look at. There's Experian score, the Equifax score, and then TransUnion. We take the middle score of all 3. So let me give you an example. If my top score is 760, my middle score is 740, my lowest score is 720, then from a qualifying perspective, we take 740 for the credit score. Now, if I'm applying with my partner, now my partner's at 720, 700, and 680, we take the lowest middle score between both borrowers. So in this scenario, my partner score of 700 would be the score that we use for qualifying purposes. And why that's important, it could impact your interest rate, could impact the loan program and mortgage insurance, which you're going to learn about in just a few minutes. So all those things are important to understand when it comes to the credit scoring method that we use as lenders. And the last thing I will just share with you before we move along from credit is account closure. If you've kind of turned over a new leaf with how you're managing your credit cards, and maybe you don't want the temptation of certain credit cards that are out there, be careful that you don't close out those credit cards. You can take those to a 0 balance, but try not to take them to a closure status, because what happens is when you do that, that can impact this 15% length of credit range. Because what happens is when I close out a credit card, it basically pulls that out of the modeling. So now I've kind of lost maybe an account that I've had for 10 years. It gets pulled out of the length of credit, and it could potentially negatively impact your credit score. This matrix here kind of shows you how negative events, how long they'll stay on your credit report. But as I mentioned earlier, the most recent 1 to 2 years from the event is kind of the most impactful to your credit score. All right, let's talk about student loans. And I know most of us are in repayment on federal student loans. They just started repayment. And I think it's important to understand when you're thinking about purchasing, how student loans are going to be calculated from the lender's perspective. So those of you that are in income-based repayment amounts, so based upon your income levels, you have the option to take an income-based repayment amount. Generally, those are going to be the lowest options offered by your student loan servicer. We can use that amount for qualifying purposes. So I want to walk you through an example of that, which is if I had $75,000 worth of student loan debt, my IBR payment or income based is at $250, then that's what I can use from a qualifying process. Now, if I don't have an income-based repayment amount, we'll use the standard payment that you have. If you're not in repayment, let's say you're in deferment or still in forbearance, then on a conventional loan, we use 1% of the balance. So in this case, it would be $750 for the payment. If we're looking at a FHA loan, the Federal Housing Administration loan, then it would be a $375 monthly payment that we would use for qualifying purposes. Certainly the IBR payment is going to be the best option for us from a qualifying perspective, but those are the things we'll walk you through as part of your consultation. One of the questions I get a lot is that, if I'm in or I'm back in school, like let's say I'm working on my master's program and I'm back in school and I don't have a repayment currently on my student loans, do I still have to count those in the qualifying? The answer is yes, because we still have to figure out what your proposed payment's going to be when you're finished up with school. So in those cases, you probably don't have an IBR payment. So we would generally take 1% for a conventional loan, or like I said, the 0.5% for an FHA product. Okay. All right, I'm going to just kind of put it back to the group. Do we have any questions so far that I can help answer? I know we had a couple of questions in the chat that I think we answered through direct message, but any questions so far? All right, because sometimes we get some questions on the student loans and the credit component, so I want to make sure that we get those answered for our group. And again, feel free to put those in the chat. Myself or my partner Ken will answer those for us, and we'll bring any questions on air with our audience tonight. Okay, let's talk about loan programs. We're going to spotlight kind of 5 key programs for you as first-time home buyers, 2 of which are going to be the most common products, which will be the conventional loan and the FHA loan product. And I'm going to talk about some of the characteristics of each one of those products. And the first product is a conventional loan with a minimum down payment of 3%. Sometimes you may hear 5% thrown around, but the minimum down payment for a first-time buyer is 3% for a conventional loan. When we think about conventional loans, those are Fannie Mae, Freddie Mac loans. Now the new conforming limit just came out, which you can see on screen, which that is changed every year. So every first of the year, there's a new conforming limit. So we go up to the conforming limit up to 3% of the sales price in down payment. As a conventional loan, the minimum down payment is 620. I'm sorry, minimum credit score is 620. And when we look at conventional loans, there's going to be some key differences between the conventional product and the FHA product, we'll talk about in just a bit. But let's kind of transition into FHA loans. So when we think about FHA, FHA stands for the Federal Housing Administration Loan. It's a minimum down payment of 3.5%, and that goes up to a loan amount of $766,550. Now, those loan limits, I should note that they will vary based upon where you're going to purchase in the state. So maximum loan limits in Santa Clara County or maybe in LA or Orange County are going to be higher than they would be, let's say, in Sacramento County. With an FHA loan, minimum down payment or minimum credit score, I should say, is 580. And you're going to have a little bit more flexibility from a qualifying perspective with FHA. It is a government insured product, so that allows us a little more flexibility from an underwriting perspective. And like I said, we're going to look at a kind of a conventional versus FHA spotlight in just a second. The VA product is going to be for our veterans that have eligibility under the product. Generally, they'll have a certificate of eligibility for their eligibility with VA. VA is an amazing product, goes down to a 620 credit score. To serve our veterans, there's a lot of flexibility in the guidelines, allows us to qualify with higher, what we call debt to income ratio. And the VA product can be also complemented with first-time homebuyer programs as well, too. USDA stands for the United States Department of Agriculture. Those are going to be for more of our rural areas in California or nationwide that buyers want to purchase in. It does have a zero down payment option, which is a really great feature of USDA. However, there are some restrictions on the program. It's geographically based, so we have to buy in certain USDA eligible areas. There's also a household income restriction, and that's based upon where you want to purchase. We can kind of talk offline if USDA is a product that you're interested in. USDA, because it has a zero down payment option, has guarantee fees up front, and there's monthly, but they're not quite as high as FHA. But I think the biggest appeal for USDA for most buyers is going to be for the zero down payment option. Of course, if it fits their home search of the kind of the area they're considering. And then finally, jumbo loans. Those are for our clients that need maybe a little bit more buying power, want to purchase beyond some of the conforming or high balance limits that are offered by Fannie Mae, Freddie Mac, or even FHA loans. Now, jumbo loans will have higher down payment requirements. Usually it's 10 to 15%. Usually higher credit score requirements, which are a minimum of usually 680 credit score. Most first-time buyers are probably not going to jump right into a jumbo loan product, but certainly the resources there for us if we need to go down that path. Now, with jumbo loans, when we think about purchasing using a jumbo product, there's also additional asset requirements. So typically we'll need to save up for our down payment and closing costs, but with a jumbo loan, there's also reserve requirements. And what reserves mean as those are additional assets that I have in addition to my down payment and my closing costs. Usually it's the equivalent of 12 months of my payment. And let's say that payment is $6,000 a month. So $6,000 times 12, I'd have to have an additional $72,000 in assets for my home purchase. Okay. So those are some of the kind of the key programs that are offered to buyers, but usually it's kind of centered around the conventional and FHA program offerings. Now, let's talk a little bit about one of those components that make up those products, which is PMI, or private mortgage insurance. That's when I put less than 20% down to purchase my home. So what we like to do in our class is to kind of dive in a little bit deeper on each one of the products, conventional and FHA, and explain to you the differences in mortgage insurance and a little bit about what the qualifying differences look like too. So for a conventional product, there's a few different ways that you can pay mortgage insurance. So typically it's done monthly, so it's concluded in my monthly payment, but you have other alternatives as too. You can also split the MI, which you can pay some of it monthly, some of it up front. You can pay some of it as what we call a single premium, where I buy out the mortgage insurance right from the start of my loan. And then I can also do, which is not very common in today's market, is called lender paid mortgage insurance. And that's where I elect a higher interest rate in order to buy out my mortgage insurance. So not something generally we'd recommend with most of our buyers. Now, in case you didn't know, mortgage insurance is not a one size fits all situation. So it's going to be based upon credit score, your down payment, and then how much you decide to finance. So oftentimes when I'm consulting with clients, they'll say, hey, Jason, I was on Zillow or I was on Redfin. I did these calculations and my mortgage insurance is like $400 a month. Well, that's because most of those calculators are not calibrated to the actual characteristics that make up mortgage insurance. So it's important to know that when you look at these characteristics and we factor those into an actual calculation, you're probably going to see a much lower mortgage insurance premium. For example, if we look at the bottom of our screen here, if we took a loan amount of $450,000 and let's say I put a minimum down payment of 3%, my credit score was 740, my mortgage insurance is about $183 a month. So not that $300 and $400 level that you might see on some of the websites that you use for searching different home options. So that should be encouraging for a lot of our buyers. That'll make it a little bit more affordable for you when it comes to using a conventional loan product. Now with FHA, it's a little bit different from a mortgage insurance perspective. There's two forms of mortgage insurance. There's upfront mortgage insurance, which is the equivalent of 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my loan amount. Those are set whether I have a 620 credit score or I have a 720 credit score. If I use FHA, those are the calculations we use for mortgage insurance. Now, one thing I forgot to mention with conventional loans is that does have a cancellation option, which potentially when you have 2 years in that loan and 22% equity, you can apply to have your mortgage insurance canceled. But on FHA, there is no cancellation option. The only way to get out of mortgage insurance is to refinance, say, into a conventional loan product. Now, FHA made changes to the MI factor about 3 to 4 months ago, and which lowered the mortgage insurance, which is super encouraging for our buyers. When we look at that same calculation of a $450,000 loan amount, let's look at it on the FHA side of things. So now the monthly PMI on FHA is about $206 per month. This is the upfront mortgage insurance. So that's the equivalent of 1.75% of my loan amount. That $78.75 gets added into the $450 loan balance. So I am going to finance more with FHA. Now that is not an out-of-pocket expense, but it is included into your total amount finance. So that's something we want to be aware of when it comes to FHA as a financing tool for you. So if you were to step back for a second, you look at the different options under both of those products, you may say, wow, FHA is going to be a lot more expensive for me. And you're probably right. There is going to be an increase in cost with FHA, but I would encourage everyone to not necessarily rule out FHA because it could be the right fit for you. Because when we look at it from an underwriting perspective, FHA is going to have a little bit of a lower credit score requirement, 580 versus 620 with conventionals. With a buyer looking to purchase, they may have past credit challenges from a delinquency perspective, or maybe a bankruptcy that has only been seasoned 2 years. That might be a better fit with FHA too. So as part of our consultation, we're going to be looking at a variety of different product options for you, but this will hopefully give you a sense of like, what does mortgage insurance look like for me considering those different products? Now, we're going to move from looking at more at the program side of things to some of the typical documents that we'll want to prepare as we consider home ownership. So if after I leave tonight's class, I'm like, hey, you know what, I think I want to learn a little bit more of my options. I want to kind of share with you guys the typical items that you'll need to start gathering in the process. So generally we'll need the last 2 years of taxes and W-2s. I know we don't have our 23 W-2s yet. Those should be to you by the end of the month. So, whenever your time is right that you're going to pursue homeownership, that'll be your most recent W-2, bank statements, and then your last 60 days of pay stubs. So that's typically what lenders will ask for in the processing of your loan. Now, while we're looking at kind of this income section of home buying, I want to kind of share with you a couple thoughts around things that we hear from buyers that may be discouraging them from purchasing a home. And that is the rule around how long I need to be on my job. So the rule in lending is I have to show at least 2 years combined of employment history and or education. So if I graduated from Sac State in the fall, and now I just started my new job the first of this year, I have 4 years of undergrad and now I'm starting my new job, that would meet the 2-year requirement. Or if I've been on my job for 6 months and I was at a previous employer for a year and a half, that would still make up my 2-year requirement for purchasing. So it's a 2-year requirement between education and work history. Now, if I have dual employment, sometimes we see this in the healthcare industry where I have maybe a job for 30 hours at one clinic, 20 hours at another clinic. In that case, I do have to show that I've been on my job simultaneously in those two areas for a 2-year span of time. Okay. Sometimes we'll run into some challenges where clients are working dual employment where they have W-2 employment, but they also have maybe they're working for Uber or DoorDash or something. If we want to use those supplemental income sources like Uber, we have to show that I've been doing my W-2 job and my supplemental job for 2 years simultaneously. The last thing that I want to kind of share with you on the income section is new employment. So let's say I'm working on my job right now and I have a job opportunity, right? Once I get an offer letter from that new employer, I can use that in consideration for my new pre-approval, and we can design options around that. So you don't necessarily have to start your job in order to have that eligible income for your upcoming home purchase. So we had a question that popped in the chat on income. So I just glanced over here real quick. Question was, what about 1099s? I think you're referring to self-employment income. So if you're a 1099, which would be an independent contractor, you would need to be 2 years self-employed or receiving 1099s for 2 years in order to be eligible. Another question I got on income was if I had a 1-year gap in my employment. So that's not necessarily, a pitfall or a challenge that we would have in financing. We would just have to have an explanation in why the gap existed. Sometimes it could be a break, or maybe it's an educational break. But as long as we can explain that and still be able to support a 2-year history, whether education or work, that should be okay. All right. Okay. So I'm going to let Ken answer that one in the chat. Let's talk a little bit about debt to income ratio, because we're going to stick with income. And what debt to income ratio does, it allows us as lenders to take a look at your monthly expenses versus your monthly income. And so it's a calculation that all lenders use. It's a calculation for qualifying, not necessarily an affordability calculation. But I want to share with you kind of how we look at it in the lens of a lender, because it's important to design the right options for our clients. But we're more so focused on affordability versus qualifying, because we want to design the right program that's going to help you really create sustainable home ownership and, most importantly, affordable home ownership. So the calculation looks like this. So we take your gross monthly income, and then we take into consideration other expenses, which are going to be like credit card debts, personal loans, student loans, car payments. All of that stuff gets factored into as expenses. Generally, we don't want those expenses to be more than 43 to 45% of your pre-tax income. Now, at times you can go as high as 50%, but generally we want to see that around 43 to 45%. Here's how the calculation works. So we need to factor in our new housing payment. So the PITI means principal and interest of my loan, property taxes, insurance, as well as PMI. So if we put less than 20% down, if I'm buying a condo, maybe a townhouse, homeowners association expenses, and then we have other debts, which would be maybe credit card or car loan. We take those expenses. So in our scenario here on screen, $3,000 versus our income of $8,500 a month, our debt to income ratio is 35.29%. So that would obviously meet qualifying for financing. The question I get often is, well, where should my debt to income ratio be? And it varies for every client that I work with. But generally speaking, most first-time buyers that I've worked with over the last several years usually feel pretty comfortable around 33 to 36% debt to income ratio. All right. We got some questions in the chat coming over. So I'll try to answer those as we get going. I do want to kind of transition into the final kind of component of building a home buying plan, which is really the down payment. I mentioned to you earlier, that's like one of the 2 challenges that can come about for first-time buyers. I want to share with you kind of the typical things that we'll ask for on the asset side of things. You saw some of that in the document checklist, but usually we do ask for the last 2 months of bank statements. We'll ask for, if you're going to use a 401k or 403b or an IRA account, we'll need the last 2 consecutive statements or quarterly statements for that. I would encourage you, if you're going to use a 401k or 403b, check with your financial advisor, your tax advisor. We don't want to create, a challenge with your investments or a tax challenge for you by accessing those assets. Gift funds can be allowed to use in home buying. That's where a family member's helping you out in your home purchase. Those assets do have to be paper trailed, but there is no seasoning requirement for those assets. Generally speaking, when you purchase a home, assets have to be seasoned at least 60 days, and we have to be able to paper trail, of course, everything. Cash cannot be used in a home purchase. So if I have money on hand in a safe at home, it cannot be used in a home purchase. It would have to be deposited into your bank. It would have to at least season 60 days for it allowed to be used in a home purchase. Now, you heard me mention about those two challenges again, either, get on the path with credit or maybe just challenges with assets and just saving up enough money for down payment. And we're proud to be a partner with CalHFA, the California Housing Finance Agency. And we have a special guest, as I mentioned earlier, Leanne Walker is going to join us from CalHFA. She's going to kind of co-host this segment of the workshop with me right now. And so we're gonna welcome Leanne to the video. I'm gonna get her on as a co-host. So let me just add her on here. And let me get you. So bear with me for 1 minute and we'll get Leanne all set up. And Leanne, are you there? Can you hear me okay? Okay.
Yes, I can.
Okay, perfect. And let me get you on video. I don't know if you want, do you want to go on video or are you good with just audio?
It doesn't matter. Whatever's easiest for you.
Okay. Let me make you co-host and you should be good. So if you want to put your video on, you're good, or you can totally up to you.
Okay.
All right. There she is.
Sorry, my light here is not that good in here. It has me orange.
You're radiating, Leanne. You're radiating.
I'm like, okay, this is not the right lighting I should be in right now. But anyway, we'll get through that. So good evening, everyone. Thank you guys for attending. Thank you, Jason, for having me. So CalHFA, we are the state of California, and we offer down payment and closing cost assistance for first-time home buyers. So as what's on the screen here, our two programs that we have right now that are year-round. Our MyHome program is what you can use for down payment and or closing costs, but most people will use it for down payment. It will give 3 to 3.5% to cover your down payment. So like Jason mentioned, the two most common are conventional and FHA. So a conventional loan requires that you put 3% down. Our MyHome will cover that full 3% down for you. And then if you're doing FHA requires 3.5% down. MyHome will cover that full 3.5% down payment for you. So MyHome's going to cover that minimum down payment, leaving you with not having to come in with any additional down payment unless you want it to. So that is the one good thing that a lot of people don't think about with down payment programs. They think it's for someone who just has no money. You can also combine your money and use our MyHome. So maybe you want to put 5% down or a little bit more to get a lower payment. You can also combine your money with our MyHome. But if you didn't have that additional money, MyHome's going to cover that minimum down payment for you. Now, MyHome is a loan that does have to be repaid. So that's one thing you want to make sure you're aware of. Any type of program that you're going to be using, you want to make sure you're doing your homework, you're understanding all the guidelines. So it's not a grant, it's not free money, it is a loan, but it's a silent loan. So it is a lien on your property, but you don't have to make any monthly payments. You're only making a payment on your first mortgage. So this stays silent until you either sell the property, refinance, or in 30 years, whichever comes first. So you don't have to make those monthly payments. Now, our hope is when anyone buys a home is that you build equity. And our hope is that when it is time for you to pay this back, you can use the equity in your home to pay it back. So a lot that happens for a lot of borrowers to where they don't have to come out of their pocket to pay it back. They can use the equity. But there may be some cases if you do sell or refinance too quickly, then and you don't have the equity built up, you may have to come out of your pocket to pay it back. But the good thing is that our interest rates are fixed. So even if the rates drop and you want to refinance, you don't have the equity, you may just have to wait a little bit longer to refinance until you have that equity to pay it back. But it's there to help you get your foot in the door now. So Jason gave you a couple great examples about buying now versus waiting. Even if the rates drop, that's going to increase the sales prices. You're going to be out there competing with more potential borrowers. So this is helping you get your foot in the door now. And again, you just pay it back when you sell, refinance, or in 30 years. It does have a low 1% simple interest. So interest is accruing, but again, there are no monthly payments. So Jason, I put the example up here. So if you got $15,000 from our MyHome, 1% interest, that's $150 a year. So that just means that every year your interest will be added of $150. So not a lot. So where are you going to borrow 15, 20, 30,000 for only 1% interest? So your bank is not going to give you that low interest rate. So that interest will be accruing, but again, only at 1% interest. Still no monthly payments. You can pay this off at any time. There's no prepayment penalties. You can make payments if you want. So definitely you can. It's just not required. And then we also have our ZIP program. So Jason talked about closing costs that you have to pay in addition to down payment. So our ZIP program can give 2 to 3% to help go towards your closing costs. Right now, we've only really been offering the 2% ZIP just due to the interest rates being high right now. We want to make sure we're giving the borrowers the best deal. So if we feel that the interest rate is too high, we are just not going to offer it. So right now, we've only really been offering the 2% ZIP. And we tell our lenders too, if you have some of your own money saved up, use your money to pay the closing costs. Or if the seller can help with closing costs, that's going to be your best bet right now. Even though their rates have kind of dropped a little bit, they still are a little bit higher. So you can get a lower interest rate if you don't need to use our ZIP. It's a great program, but it is going to increase your interest rate. Yeah. So that's really going to be for the people who really need it and they don't have the money to come in with their closing costs and you can't get help from the seller. We are seeing a lot where the sellers are willing to help with some closing costs. So that would be a good option for you. And that's something Jason's going to do for you when you do a consultation with him. He'll look at your whole scenario and figure out what is going to work best for you. But you can put these two programs together. Prior to when the rates got higher, this is what we saw every day. We saw our MyHome and our ZIP. It was helping people get into a home with very little, sometimes even no money at all. But right now, the best bet is probably just the MyHome, and then either have the seller or you come in with the closing costs. But again, if you did need that help with closing costs, you could add and get at least 2% from the ZIP. So those are our programs that come from, we're a self-funded state agency. So these programs don't come from the general fund. They're not affected with the budget. So we have these year round. So even if you're not ready to buy now, we always have a program. We've been around since 1975, so we're not going anywhere anytime soon. I'm going to make sure of it because before I retire. Don't feel like you have to rush if you're not ready. We're always going to have a program available. Now, everyone wants to know about the Dream for All. I don't have a lot of information to share. We still are finalizing everything. We're kind of waiting on the state right now. So just to give you a little bit of information, the Dream for All, it does come from a Senate bill that got passed with the state budget. So it's not CalHFA's funding. We are just the administrator for that program. So we're relying on the state to give us the money for this program. It is a shared appreciation loan. So that is one thing you want to make sure you do understand. So we're going to give you up to 20% for your down payment. And then when you do go to sell or refinance or in 30 years, you do have to pay back this 20% loan. and then share 20% of what the home appreciated. It sounds scary. It's not as bad as what it seems, but it's helping you get your foot in the door now. And this is really going to be for borrowers where MyHome and ZIP may not help you. Maybe you need that bigger down payment. So even though MyHome is going to cover your minimum down payment, some cases borrowers need that 20% in order to buy a home because the rates are up, the prices are up. So you may be priced out of the market. So this is what this is going to help you get a bigger down payment to help you qualify for a little bit more. So the first round that we had in March, at the end of March this year, it went in 11 days. So it was a little bit crazy. So we did have to make some changes. So there's going to be some big changes coming. It is not going to be first come, first serve anymore. It is going to be a lottery system. So this is one we're telling people, don't wait just for the dream for all, unless that is your only option. If you can qualify now using MyHome and even maybe ZIP, we say go for it, because this is going to be a lottery system. So it's going to be random. So no one is guaranteed to get this funding because we have limited amount of funds. So we have to try to see what we could do to help the majority of the people that we can. So it's still going to be a 20% down payment or $150,000, whichever is less. So for those of you buying in higher cost counties, that's where you may not get the full 20%. You'll be capped at that $150,000. But for the majority of people, you will still get the full 20%. This is on conventional loans only. So this is one reason why we like to talk about this now. It's not going to be released probably until April right now. But in case you do have some credit issues, you can start working on those now. Because like Jason mentioned, conventional is going to be a little bit harder to qualify than FHA. So that way you could get prepared. You may be qualified for FHA right now, but maybe you don't qualify for conventional. So that way you can start getting ready. So when we do open this back up in April, that you will be ready. So that lottery system is going to be the biggest change. So once we announce the portal is going to open in April, you still have to get pre-qualified from a lender. And then they'll issue you a pre-approval letter. You, the borrower, will go into the portal yourself and do the registration. And then you're going to upload the approval letter from the lender. So we're going to have a separate form that we're going to have the lenders fill out. So it's going to be equivalent to what their approval letter would be. So they will fill that out, give that to you. So then when you go to register, you have to upload that approval letter. The portal is going to be open for about between 25 to 30 days. So you'll have time. So you don't have to rush out on day one. You'll have that full month to be able to get everything uploaded. Once the portal closes, nobody can enter it anymore. And then we'll do a random selection. If you get selected, you will get issued a voucher, and that voucher will allow you to go now shop for a home. So that way, you know, when you're looking for a home, you know you got selected for the program. So that is the biggest change. That way it's equal across the whole state, and we are going to go by county. So we wanted to make sure it is equal through the whole state. So it is going to be selected by county. So whatever the population is of that county, that's how many loans and vouchers we will assign for that county. One of the other biggest changes that will eliminate a lot of people, and this was a state requirement, that you have to be a first-generation home buyer. So our programs require that you are a first-time home buyer. You haven't owned your primary residence in the last 3 years, but with the Dream for All round 2, at least one borrower has to be considered first generation. We've been kind of, going back and forth with the definition, what it looks like it's going to be now. Like I said, all of this is subject to change. Nothing is final. That means that you, the borrower, have not owned a property in the last 7 years, and your parents do not currently own now. Or if your parents are deceased, they did not own a property at the time of their death. So at least one borrower would have to be considered first generation. So if your parents currently own a home, then that disqualifies you, unless you are applying with another person and that person is first generation. So we made it a little bit easier because at first it was going to be the borrower has never owned and your parents haven't owned in the last 10 years. So we at least got it down to make it a little bit easier. But due to us having limited funding, that's what the state wanted to focus on, first generational home buyers to build that generational wealth. So that is, and this is something that is going to be checked. It is going to be audited. So you have to make sure you are being truthful on that, because there is going to be a form that you do have to fill out, and every loan will be audited to double check that. So we are hiring an outside company that is going to do those investigations. So please make sure that you are being honest about that. Also, the income limits are going to be a little bit lower than our regular program. So right now, it's called AMI, Area Medium Income. So they look at each county and take what the medium income is. Our current, for MyHome and ZIP, we go to 150% over that. Dream for All is going to be 120%. So still not really low, but it's going to be lower than what we offer right now. So that's pretty much the changes that are being proposed. We are again waiting on the state to give us final approval. Once we get that, we will announce. We're hoping to hear something in the next couple weeks. So we do encourage everyone to sign up for our e-news on the CalHFA website. As soon as we get the go-ahead, we're going to go ahead and send out a bulletin that will announce all the final guidelines for the program. That way lenders can start working with borrowers to see if they're going to meet all those updated guidelines. And then the portal will open later in, right now, looks like April.
Awesome. That's great. Wow, Leanne, that's a lot of information.
Yeah, I know. Be good for you guys. You have Jason, so you don't have to remember everything that I just said. And, I said like 30 minutes worth of stuff in 5 minutes, but
no, that's great. That's great.
But definitely, Jason can walk you through that. So he signed up for e-news, gets all the notifications. So as soon as we have everything finalized, we'll send that out. That way everybody gets all the same information at the same time.
Yeah, that's awesome. And for our guest tonight, Ken will go ahead and put the link to the e-newsletter sign up for CalHFA in the chat. So feel free to subscribe to that, and you'll get the latest information from CalHFA. So Leanne, I appreciate everything tonight. That's awesome. You gave us a lot more than we were expecting, so I appreciate that. And hopefully those of you that have been hearing about California Dream for All, you're getting accurate information from Leanne, not just social media buzz or whatever. So, but it's more kind of a stay tuned type of situation. And once we get the final version of what this product will look like, we'll certainly share it back with all of our guests for sure. So thanks so much, Leanne. I appreciate everything.
Thank you.
All right. Have a great night, and we'll wrap up with the rest of our content for the group.
Okay. Have a good evening, everyone.
All right. Thank you. Awesome. All right. Well, that was fantastic. And I'm so glad Leanne was able to share that with you. And I know we gave you a lot of information, and I generally have some additional things with CalHFA that I share. I'll let you know that we are going to pass along, because of the time frame, I'm going to pass along the rest of this information, of course, in our deck page. But this is the income limits that Leanne was referring to. This is the 150% of AMI. This is the 120% that we're expecting with Dream for All. So that's where there's going to be a little bit of difference. So I know a lot of folks in our community are super excited about Dream for All, but there is going to be some changes, as Leanne mentioned. And, you're hearing those direct from CalHFA about what the proposal looks like. So hopefully that's helpful for those of you that are considering the California Dream for All. Once that program goes live, and we're expecting potentially those guidelines to be available next month, I'm going to be hosting live YouTube classes to be able to help educate future first-time homebuyers on that program. So stay tuned for that. I would encourage you to sign up or just subscribe to our YouTube channel at J Mada Mortgage. We'll get some more information out to you as that's available. All right, so I want to just walk you through the 6 steps of home buying. We're going to do just kind of a light version of it because I want to respect everyone's time, and just give you a quick high level on what this looks like. These is the kind of the path towards home ownership. So after attending tonight's class and you want to learn a little bit more about what a home buying plan might look like for you, this is kind of how we get on that path. And the first place we would start is doing a consultation. Now, the output of a consultation will be to be pre-approved. So if you're saying, hey, I want to look at a CalHFA product or a standard conventional loan, or maybe eventually I want to be qualified for the California Dream for All, this is a pre-approval, which basically says you're eligible for financing. It gets presented to a seller. Usually that's good for 60 days. Now, after that comes the house hunting side. That's when you generally partner with a realtor to see different homes that are available in your market. Generally speaking, realtors that support you in your home search and help negotiate your contract are paid for by the seller. Now, if we find a home that we love and we want to make an offer, if that offer gets accepted, then we move to step 3. That's called entering escrow. So that's when a seller has accepted the offer to our home. We usually have 2 to 3 days to make a deposit called an earnest money deposit on that place. It is a potentially refundable deposit, but it gives you a security kind of interest in that property. Now, within 24 hours of your accepted offer, we're going to reach out to you, say congratulations, let you know that we have received word of your accepted contract. And then from there, what we'll do is we'll explain to you the next steps in your buying process. This slide kind of highlights what an earnest money deposit is. So it's generally the equivalent of 1 to 2% of your purchase price. And when you're in escrow to purchase your home, the escrow time period is usually 30 days, but you have the first 14 to 17 days called a contingency period to do your kind of homework on the property. That homework will include usually getting your house appraised, getting your loan approved, and then doing inspections on your house. But your deposit is generally protected during that span of time. Step 4 is going to be processing and underwriting. That's where we do a lot of the administrative work on your loan. Prior to the processing of the loan, we're going to be doing what we call a follow-up consultation with you. And in that follow-up consultation, what we'll do is kind of show you what the design of your financing looks like with kind of real-time numbers based upon your negotiations with the seller. And then step 5 is loan approval. That's when your loan has been approved through the underwriting team. At that stage or that particular milestone, you have your loan approval. You're now about 3/4 of the way through the process. So you're also probably at the end of your contingency period. So your appraisal is back, your loan's approved, you've done your inspections. So if you feel comfortable with the homework you've done on the property and you want to move forward, then you would release your contingencies. When you release the contingencies, that also exposes your deposit. So you want to make sure you feel really good about the property before lifting that contingency. Now, as a lender, we're also going to deliver to you a closing disclosure at step 5. It gives you a 3-day cooling off period before we move to the final stage called closing the loan. That's where you'll actually sign documents in person with a public notary. Any funds that you have remaining in your transaction will be deposited at that time. And then those monies get reconciled by the escrow team, including the loan funds that we provide for you in your financing. Once that's all completed, documents get recorded with the county recorder's office. They'll usually record a grant deed to transfer ownership, and then a deed of trust, which is your agreement to repay the loan. And so that's kind of what that process will look like. And then once we get the recording confirmation, that's when you become the official owners of the home. That's my favorite part of my day. I get a chance to call all of our new home buyers to tell them that congratulations, you're now a first-time home buyer. I got a chance to make that call. That was one of our first calls today for 2024, our first home buyer. Like I said, best part of my day because it's a huge accomplishment. This is probably going to be one of the biggest upcoming investments you make in your financial future. So it's a big deal. The fact that each of you, took out an hour plus of your time on a busy Wednesday night to learn about homeownership tells us all how serious you are about this next opportunity for you in homeownership. So if you're thinking about moving forward in the process, want to learn a little bit more about what your home buying plan can look like for you, we'd encourage you get connected with us for a consultation. It's a free service we provide. It's a really easy step process. You complete an online application. We only do a soft credit check, and then you'll upload proof of income and assets. So if you're thinking, hey, do I qualify for this product? Would the California Dream for All in the future be a good fit for me? Those are all things that we can help identify through our consultative process that we do for you. Now, if after tonight's class, you're like, hey, I just have a couple questions about my income or a credit question, get connected with us for an introductory call. You can schedule any one of those services through our link that I had on the previous screen there. And then this is kind of what the consultation looks like. You've heard me talk a little bit about it, but we're going to help you with your budget. We're going to help you understand interest rate options, program options, assistance programs, learn more about your credit and how to improve it. All things that are going to help support you on this path towards homeownership. And resources, we have at your disposal, including our mobile app where you can start your application process there. You can search like the process, you can do calculations all via mobile. You can upload your documents. So we try to make things as technology friendly as possible, but we don't want to miss kind of the human element of this process, right? This is a big deal for you guys making this upcoming purchase. So we want to make sure our team is available for you, whether it's phone call, email, video, text, but the mobile is one of our other resources that we have available to you. Now, as we launched in tonight's class, I said most of you are probably joining us from our Sac State partnership, which we're super proud of, but we also have other partnerships across the country. Here's to name a few of those. We have 13 partnerships with different university alumni in 2024. Super excited with those, as well as discount programs available for state employees. And so, if you kind of fit in one of these partnerships or discount programs, we'll definitely want to make sure we pass those along to you. And if you liked what you heard in tonight's session, we'd encourage you pass along this information to friends, family, coworkers. Like I mentioned earlier, we have our YouTube channel. You can follow us at J. Mortgage to see all of our upcoming live classes or check out some of the recorded versions. And this is all my contact information. So if you want to get connected with me after this class, feel free to reach out to me. I try to make myself as available as much as possible. And we love to celebrate homeownership. So a lot of what we are doing for our clients in our local communities, classes that we're teaching, you can find on our Instagram, as well as, some of the testimonials from our clients are on our Google reviews. We'd encourage you to follow us on Instagram because a lot of the stuff we update on programs, especially with California Dream for All, will be coming up on our Instagram. You can follow us there at J. Mortgage too. So with that said, I know I'm over my time, my 7 o'clock, but hopefully this information was well worth your time. We appreciate everyone taking time out of their busy evenings to join us. I want to wish everyone a very happy new year. May it be a prosperous, healthy, and successful year for you and help you accomplish all of your financial goals. And hopefully homeownership is one of those goals in 2024. I'm going to go ahead and stay online. So if there's any questions that we need to get answered, we'll keep the lines open, but I do understand if you need to drop off. But we appreciate you joining tonight's class. Okay, and I think we're good. All right. Thank you so much, everyone. Have a wonderful evening. We'll talk to you soon.